How can you tell if the CEO of the company that you're considering investing in is following a rational capital allocation approach? Hi, my name is Gary Mishuras. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the F.W. Olin Graduate School of Business. So I've talked to a lot of CEOs in my almost 2 decades of investing, and some of them know exactly what they're doing on capital allocation and are amazing. Some of them, less so. And think about it this way, right? How did the CEO become a CEO? A lot of times he was a senior sales guy or a senior operational leader, became a head of a division, and and basically bumped off his competition and became the CEO. And nowhere in that process did anyone formally teach him how to allocate capital. And now he's the CEO, and he's kind of in some ways winging it, right? Because yes, he has his board, but let's face it, the board meets 4 times a year and mostly rubber stamps what the CEO tries to push through. Unfortunately, that's the default. There are other obviously exceptions to this, but a lot of times that's what happens. All right, he has a CFO, but look, the CFO works for the CEO, and ultimately, if the CEO calls a shot, the CFO is rarely going to say, you know what, this is a terrible idea. And also, the CEO ultimately is the capital allocation, guru or person in charge of that. The CFO is there to help him execute. He's not there to set the capital allocation strategy necessarily. So I guess if you're an investor and you're interviewing a CEO, what do you want to see? I think you want to see 2 things. One is you want to see that there is an intrinsic value framework to capital allocation. So you want to hear that the management has an internal process for assessing the intrinsic value of potential investments, whether they are acquisitions, share buybacks, and so forth. And that they have, it doesn't have to be precise. Look, intrinsic value is always imprecise, but that they're thinking about the intrinsic value of those opportunities. And secondly, what you want to see is you want to see that the company is comparing each alternative to all the other alternatives to the opportunity cost, right? So let's say a company is considering share buybacks. Well, here are some terrible things I've heard from CEOs and CFOs over the years. Well, we're doing some share buybacks to offset dilution from stock options. And that is awful logic, makes no sense. Okay, so you issued some options, that's employee compensations. Okay, fine, so you have now more shares outstanding, that's fine. That's gone, that's one decision. So why do you need to offset that? Let's say that the stock is trading for 2x what you think it's worth. Should you still be offsetting this dilution? No, that makes no sense. So if you hear that, you have a problem. What else? Another problem is, we did this deal and it's accretive to EPS. Well, yeah, duh. I mean, with interest rates where they are, and with acquisitions funded by a combination of debt and equity, or sometimes just debt, it would be really hard for a deal not to be accretive to EPS, right? Well, Mr. CEO, did you actually look at other alternatives? So maybe you earned a 8% return on your invested capital by doing this acquisition, but you could have gotten a 12% return by buying back your own stock. Did you think about that? If you didn't, it doesn't work. So you want to have people who are thoughtful about intrinsic value for each option, and you want them to be comparing those options constantly and thinking of each option as the opportunity cost for the other in making decisions. And ultimately, over time, you'll see what their record is at making these deals. But I'll tell you this: for at least share buybacks, the record for American CEOs as a whole is terrible. I mean, you would think that if anyone could, with perfect insider information, being the CEO, could, buy the stock when it was undervalued and, not buy it when it's fairly priced or more than fairly priced, it would be the CEO of the company. Yes, they have some blackout windows, and they certainly am not suggesting that they should, front run, other investors with something that they haven't publicly disclosed. But there are many a time when they've released information, everyone has the same information, and the stock market's undervaluing the company. And who do you think knows the company better at this point? Some sell-side analysts or the CEO of the company? Presumably the CEO. So you would think that if anyone, companies would buy back their own stock when it's undervalued and not do so when it's overvalued. Well, that is not the history at all. If you look at the history of share buybacks, it's completely pro-cyclical, meaning when the stock market is all-time high and everyone feels confident about business trends, the CEOs as a group go out and buy a ton of stock. By the way, usually at very high valuations. And when you have a recession, there's a temporary lull in business activity, and the stock market sells off their stock, the same stock that they were buying at 2x last year when things were going great temporarily. Now they're afraid to buy it at X, at half the price. And they buy nothing or very little. And of course their board say, well, we just want to be prudent, we want to wait and see. No, that's not prudent. That's just, being conventional in your thinking and not really having a thoughtful capital allocation framework. Now, if you have too much debt or you have other problems with the business where you think you need the funds for something else, that's another matter. But there are plenty of times when companies have plenty of capital available and they just freeze up when the stock is undervalued and they don't act, but they are more than happy to act when the stock is fully priced to overvalued. So those are the type of things you want to watch out for. And over time, both the way the management team communicates it in a capital allocation framework and the way they actually execute in terms of, do they actually act on that framework in a rational way, should give you a pretty good idea if they get capital allocation or if they're, part of that large group of CEOs who just never learned how to do it and they're, trying to wing it, and maybe $1 of free cash flow in their hands isn't worth quite as much as $1 in the hands of a good capital allocator. So it's just something to consider as you consider valuing the business. If you like this video, please hit like and subscribe to the YouTube channel for more educational video content. Thank you.